Dear traders, understanding psychology and technical analysis is essential. But without proper money management, you won't be able to scale your trading and become profitable. So, in this video, I'm going to share with you the concept of money management and how to use it. So, let's move on to our first structure. So, you must be wondering, what is money management? Money management is all about how you manage your capital and your risk when trading. Okay, the money that you deposit in your broker is called capital. Alright, so now you must be also asking, why is money management so important, right? This is because money management can assist you in number one, controlling your emotions. If you have risk management in place, you're less likely to take revenge when you lose your trade and be greedy when you profit. For example, if you set a proper risk on how much you're willing to risk in every single trade, even if you hit your SL, okay, you won't revenge trade and lose your capital in one single trade. You don't want to do that. Second, to minimize your risk, you need to know how much capital you are willing to risk on each trade and why you enter and where do you set your stop loss order to get out from the trade. Okay, and lastly, to remain consistent. Alright, remaining consistent and growing your capital is one of the hardest things a beginner trader experiences, but you can overcome this by having a good money and risk management. Okay, by risking the same percentage for every single trade will allow you to remain consistent. Okay, so now let's move on to our next part. What risk control method can you use to protect your capital and trade with good money management? Okay, so number one is only use money you're willing to lose. What I mean by this is, if you have an extra $50 left after paying your bills and all the important stuff, then you can use the $50 to trade. So if it results in loss, it won't significantly impact your finances and your emotions. All right. Number two is set a specific limit of losses per day. For example, if you are a day trader, you should set max 3 losses per day and you stop trading for the day. That's it, okay? This is to avoid and train your emotions to not get involved and revenge trading, all right? Number 3 is set stop loss. Always remember to set a stop loss to limit potential losses. You need to know when to get out, alright? Just remember, as long as you follow your trading plan and it hits your SL, well, this is fine because there's always going to be losses in trading. But the winning should cover your losses and you follow your plan, right? You train yourself to be disciplined. Number 4 is emotional control. Don't let fear influence your decision. For example, avoid revenge trading and closing your position just because the price is floating. Be patient and trust your setup. I know all beginners traders does this. So, number 5 is set risk to reward ratio. You have to learn how to take a trade that gives at least minimum 1 to 2 risk to reward ratio. So the risk to reward ratio is a crucial concept in trading that helps traders manage their risk effectively. It refers to a ratio of the potential profit of a trade to potential losses. So you have to learn how to take a trade that gives at least minimum 1 to 2 risk to reward ratio. All right. For example, if you enter a trade with a risk to reward ratio of 1 to 2, it means that you are willing to risk $1 for a $2 profit. All right. Lastly is set position sizing. Position sizing refers to the risk percentage. You can risk 1%, 2%, or 3% of your trading balance. However, I recommend using only 1 to 2% of your trading balance. Risking more than 3% is very risky. Okay? And that's it. Let's move on to our next part. So, what is risk to reward ratio? Risk to reward ratios is used to define the amount of money you are prepared to lose versus the amount of money you could make. Okay, so risk to reward ratios is shown as a ratio. For example, 1 to 1 risk ratio means you are risking 20 pips to gain 20 pips profit, and 1 to 2 risk to reward ratio means you are risking 20 pips to gain 40 pips profit. And lastly, 1 to 3 risk to reward ratio means you are risking 20 pips to gain 60 pips profit. Okay, so as you can see here, the first number represents the risk and the second number represents the reward. All right, so you are basically risking $1 to get a $2 profit. This is risk to reward ratios. It can be 1 to 2 or 1 to 3. 1 to 3 means you are risking $1 to gain $3 profit. Alright, so now let's move on to how to set up lot size based on your capital risk. Alright, so now let's take a look at how to set up lot size based on your capital. This on the left here is my signal that I provide in my free Telegram channel. This signal itself hits 130 pips, okay? So I will explain how to calculate the lot size based on your risk capital. For example, my account's balance is 100 USD, right? And I want to risk 2% of my capital to enter the gold trade here, right? With a 20 pip stop loss from my entry. In here, I give you 23.93 to 23.96. So my entry was a 20 pip stop loss from the entry. First, we'll take the account balance, which is the $100 here, okay? And then we're gonna multiply it by 2%. That means you will get risking only 2% in this trade, alright? This is the amount you should use for your trade. So next we calculate the stop loss, alright? So 1 pip is equal to 10 points. So 20 pip stop loss, you times 10 points, you will get 200 points. And then lastly, you will use the $2, right? The $2 we're gonna risk divided by 200 points, which is equal to 0.01, which is the lot size that you have to use, okay? So this is how you can calculate your lot size based on your capital. So the last part of money management would be recommended lot size, the most popular questions ever. So now I have prepared here recommended lot size table for you guys based on your capital. The first one would be 50 USD. For low risk, you can't layer. You have to stay within the 0.01. Medium risk, you can layer up to 5 position if you want to, or 2 position, but within 0.05. And high risk is 0.10. And then for 100 USD, it's 0.01 as well. For low risk and medium risk is 0.10 and high risk 0.20. And 200 USD capital is 0.02 for low risk, medium risk is 0.20 and high risk is 0.40, okay? And then for 300 USD is 0.03 for low risk, and then for medium risk it is 0.30, and then for high risk is 0.60. And for 500 USD is 0.05 for low risk, for medium risk is 0.50 and high risk is 1 lot. 1000 USD is 0.10 for low risk, and then for medium risk is 1 lot and high risk is 2 lot, okay? So the bigger the risk, the bigger the reward, as you guys know. Okay, we have come to an end of our money management topic. If you're interested in learning more about simple and effective trading strategy, click the link in the description below. In my community, you can connect with traders around the world to share knowledge and experience. So thank you for watching. If you enjoyed this video, please like, comment, and subscribe for more content. See you guys in the next chapter. Bye.